The IRS already knows how much cash is in your bank account right now. Not approximately, not a rough estimate, the exact amount, the exact transactions, the exact deposits and withdrawals going back further than you probably realize. And if you are on Social Security or Medicare, they have been building that picture of your finances quietly, automatically, and legally without ever sending you a notification that it was happening. Most people assume their bank account is private. They assume that what goes in and what comes out is between them and their bank. That assumption is costing seniors across this country real money, not because the IRS is targeting them unfairly, but because there are specific rules about what triggers IRS attention, specific dollar amounts that cause automatic flags, and specific moves that seniors make every single month thinking they are normal and routine that are actually putting their accounts directly in front of federal scrutiny. And here is the part that should make you stop what you are doing right now. The IRS does not have to audit you to act on what they see. They do not have to call you. They do not have to send a warning letter first. They can simply adjust what you owe, reduce what you receive, or flag your account for a level of review that most people do not discover until it has already affected their finances. I'm going to walk you through exactly how the IRS gets your banking information, exactly what triggers a flag on a senior account in 2026, exactly what dollar amounts cross the automatic reporting threshold, and the specific moves you need to make before your next bank transaction to make sure you are not creating a problem for yourself without even knowing it. Stay until the end. The last thing I tell you is the move that most seniors make thinking it is completely safe, that the IRS considers one of the strongest flags on a senior account. It catches people off guard every single time. If you are not subscribed to this channel, do that right now and turn on the bell. The rules around bank reporting, IRS thresholds, and Social Security income taxation change constantly. When they change, the IRS does not send a personal explanation of what it means for your specific account. This channel does. Subscribe and let's get into it. Here is how the IRS already has your banking information. There are 4 separate legal channels through which your bank sends information about your account directly to the IRS, automatically without your permission required and without any notification to you. Channel 1 is the SSA 199. Every January, the Social Security Administration sends the IRS a document listing exactly how much Social Security you received during the previous year, how much Medicare was deducted from your payments, and how much federal tax, if any, was withheld from your benefit. The IRS receives this automatically for every single Social Security recipient in the country. They do not wait for you to report your Social Security income. They already have it before you file anything. Channel 2 is the 1099-INT. If you earned any interest from a bank account, a savings account, a certificate of deposit, or any other interest-bearing account during the year, and that interest exceeded $10, your bank is legally required to report it to the IRS, not to you first, to the IRS simultaneously. By the time you receive your copy of the 1099-INT in January, the IRS already has the same information sitting in their system. Channel 3 is the Currency Transaction Report, the CTR. This is the one most people have never heard of, and it is the one that catches seniors most frequently off guard. Federal law requires every bank in the United States to automatically file a currency transaction report with the Financial Crimes Enforcement Network, which shares that data with the IRS. Anytime a customer makes a cash transaction exceeding $10,000, not withdrawals only, deposits too, and not just in a single transaction. If you make multiple transactions in a single day that together exceed $10,000, those are also reported as a group. This is not a punishment. It is not an accusation of wrongdoing. It is automatic. Your bank does not call you before filing it. They do not ask your permission. They do not notify you afterward. The report goes in, the data moves to the federal system, and your account is now associated with a transaction that federal agencies can see. Channel 4 is the Suspicious Activity Report, the SAR. Banks are legally required to file these when they detect patterns of transactions that appear designed to avoid the $10,000 reporting threshold. This is called structuring, and it is the move I told you to stay until the end to hear about. Now here's what is happening in 2026 specifically that makes this more relevant for seniors than it has ever been before. The IRS announced enhanced monitoring of financial accounts belonging to Social Security recipients in 2026 as part of a broader initiative to identify unreported income and ensure that seniors paying taxes on their benefits are calculating the correct amount. The specific focus areas include large cash withdrawals by seniors, deposit patterns that do not match reported income levels, and discrepancies between what SSA reports a person received and what the person reported on their tax return. Let me explain each one. Large cash withdrawals. If you regularly withdraw cash from your bank account in amounts that approach or exceed the $10,000 threshold, your account will be flagged, not necessarily audited. Flagged. That means a human being at a federal agency is now looking at your account activity. They are comparing your Social Security income, your reported tax liability, and your cash movement patterns. If what they see does not add up cleanly, your chances of receiving a notice, a request for documentation, or a full audit increase significantly. Deposit patterns that do not match reported income. If money is coming into your bank account from any source that is not reflected in your Social Security income and your tax return, the IRS wants to understand where it came from. This includes gifts from family members above the annual gift exclusion amount of $18,000 per person in 2026. It includes proceeds from selling personal property, vehicles, or collectibles. It includes payments from informal work, caregiving, babysitting, or any other income source that most seniors consider too small to report, but that federal systems can detect when they do not match up. Discrepancies between SSA data and tax return data. This one is straightforward. The IRS has your SSA 199 before you file your taxes. If what you report on your return does not match what the SSA already told them, even by a small amount, that discrepancy creates an automatic flag that can trigger a review of your entire return. Now, here's the specific dollar threshold that most seniors do not know about, and that is causing problems for people who have never done anything wrong. $10,000 is the currency transaction report threshold, but there is a second threshold that matters even more. Any series of transactions and over any period of time that appears designed to stay below $10,000 to avoid the reporting requirement is itself a federal crime called structuring. You do not have to intend to structure. If the pattern looks like structuring to federal automated systems, your account gets flagged as a potential SAR, suspicious activity report. Here is what that looks like in practice for seniors. You want to make a large cash withdrawal. Maybe you are helping a family member. Maybe you are making a large purchase. Maybe you simply prefer cash for certain expenses. Instead of taking out $12,000 at once, which you know will be reported, you take out $4,000 on Monday, $4,000 on Wednesday, and $4,000 on Friday. 3 trips, 3 transactions, each one below $10,000. That pattern, specifically because it appears designed to avoid the reporting threshold, is exactly what the suspicious activity report is designed to capture. Your bank is trained to identify it. Their systems flag it automatically. And when a SAR is filed on your account, federal agencies have the ability to investigate without notifying you first. This is not a hypothetical. The Financial Crimes Enforcement Network reported in 2025 that SAR filings on accounts belonging to Social Security recipients increased by 23% compared to the previous year. Most of those cases involve people who had no criminal intent. They simply did not know the rules. Here's what you should actually do. Step 1, know your numbers, log into your My Social Security account at ssa.gov and look at your SSA 199 from last January. Box 5 shows your total Social Security benefits for the year. Box 6 shows federal tax withheld. These are the exact numbers the IRS already has. Make sure your tax return reflects the same figures. Any discrepancy, even a small one, creates an automatic flag that triggers a review. Step 2, understand your combined income and whether your Social Security is being taxed correctly. Take your adjusted gross income from your tax return. Add any tax-exempt interest income. Then add exactly half of your total Social Security benefit for the year. That is your combined income. If you are single and it exceeds $25,000, some of your Social Security is taxable. Above $34,000, up to 85% is taxable. If you are married filing jointly, those thresholds are $32,000 and $44,000. If your combined income puts you in a taxable range and you have not set up voluntary withholding from your Social Security check, file a W-4V with SSA immediately. Download it at ssa.gov. Choose a withholding rate of 7, 10, 12, or 22%. This ensures your tax obligation is being handled automatically throughout the year and eliminates the discrepancy that triggers IRS attention when you owe money you have not been paying. Step 3, be deliberate about cash transactions. If you need to make a large cash transaction, above $5,000, consider doing it in a single transaction rather than breaking it into smaller amounts over multiple days. A single transaction over $10,000 gets reported automatically, but creates no additional scrutiny because it is transparent and expected. A series of transactions that look designed to avoid the $10,000 threshold creates a SAR flag that brings a level of scrutiny no one wants. If you are making a large cash transaction for a legitimate reason, helping a family member, purchasing property, making a large personal purchase, tell your bank teller what the money is for. Banks are trained to ask, and an honest answer from a long-standing customer who offers context is treated very differently than silence or evasion. You can also ask your bank to document the purpose of the transaction in the account notes. That documentation protects you if anyone ever reviews the transaction later. Step 4. Check whether any deposits into your bank account over the past year were not reported on your tax return. Gifts from family members, payments for informal services, proceeds from personal property sales. If these came into your account and were not reflected on your taxes, you may have an unreported income issue that the IRS can detect by comparing your deposit patterns to your reported income. Talk to a tax professional before your next filing if you are not certain whether something you received should have been reported. Step 5. If your Medicare Part B premium is higher than $185 a month right now, look at your Social Security deposit statement. The Part B deduction is listed separately. You may be paying an IRMAA surcharge based on income from 2 years ago that no longer reflects your current financial situation. File Form SSA 44 with the Social Security Administration. Show what your income looks like now. The surcharge gets reduced or eliminated, and people are getting $200, $300, and $400 back every single month by filing this one form. And every month you wait is a month of that surcharge being deducted unnecessarily. Here is the summary of everything you need to know. The IRS receives information about your Social Security income, your bank interest, and your large cash transactions automatically before you file anything and without notifying you. In 2026, IRS monitoring of senior accounts has been enhanced specifically to detect discrepancies between SSA reported income and what seniors report on their taxes. The $10,000 cash transaction threshold triggers an automatic currency transaction report. Patterns of transactions that appear designed to stay below $10,000 trigger a suspicious activity report. And that flag brings a level of federal scrutiny that most people do not discover until it has already begun. Log into ssa.gov. Compare your SSA 199 to your last tax return. Calculate your combined income and confirm whether your Social Security is being taxed at the right level. Set up withholding with the W-4V if you have not done so. And be deliberate, not evasive, deliberate, about how you handle large cash transactions. The IRS already has your information. The question is whether your information is accurate, consistent, and documented in a way that closes the door on scrutiny, or whether it is leaving that door open without you realizing it. Share this with one person you know who is on Social Security and has a bank account. That is everyone. One share could save someone from a situation they did not create and did not even know they were in. I will see you in the next one.